Chelsea, are we recording? Just double check.
Yep, I just started it.
Awesome. Thank you so much. So I'm not going to be able to see everybody's faces as I'm presenting, so forgive me if I'm missing something. So please free to speak up and let me know if you've got questions along the way, and Meryl, if you can help. So welcome to the 17th resilience update. So thank you everyone again for taking some time with us in August. So what we're going to be doing today is we're going to do a first half of 22 review, and then a little bit of an outlook on the second half of the year. So one of the things probably not lost on anyone in this call is I thought we'd be able to kind of rename this session from resilience, but the macro lords between the pandemics and wars have made the last couple of years pretty challenging. The second half doesn't look like it's going to get much better, unfortunately, and I'll take you through some of our perspectives there, and then we'll do a quick update on the fund, and then switch over to Q&A. So in terms of economic outlook, again, I don't think this is going to be new news to anybody here, but just to give our perspective, the Fed has definitely shifted to focus on inflation in the second half of the year and willing to accept higher unemployment. I'll talk a little bit more about that in a second. But this really means lower economic growth, probably for at least the next 4 quarters. Consumer confidence, is now at sort of historic lows as prices and goods, are having some real impact on people's kitchen table, including gas, food, and shelter. Some nice progress in the news this week in terms of gas prices coming down by 20%, but we're still seeing inflation well above a 2% target and closer to 10%, and a little bit stubborn there. And I don't think that that's going to be an easy fix, but we've got some smart folks on with us today, so we can maybe ask their perspectives as well. We are seeing rotation out of growth stocks, both in public and private markets. And I can talk a little bit about where we're seeing capital flows move. And then last but not least, pretty significant geopolitical risk, the most I've seen in my investing career, if you look at what's happening in Europe as well as in Asia. So what's sort of the tale of the charts on that front? If you look at that where the Fed funds rate, and happy to have others jump in here to get their perspective. But if you look at where the Fed funds rate is sitting right now compared to where inflation is, there's still a pretty massive gap there. And despite some things on the supply side getting a little bit better, historically you've had to see Fed funds rate get pretty close to the inflation rate to get it under control, and there's a still big gap there. In terms of cycle, I guess where our perspective is, we haven't seen the worst of what's likely to be in the markets as it relates to both the geopolitical risk and inflation risk. We expect to see that really early next year. So we've got a couple tough quarters ahead of us from our perspective. And the biggest driver really is going to be consumer confidence and U.S. consumer confidence on our portfolio performance. And so that's one of the things that we're watching pretty closely. This chart, I think, just kind of brings into sort of 3 numbers we're thinking about. U.S. consumers are still increasing their personal expenditures in real terms, and I think that's largely because the employment markets have been so healthy and continue to be healthy. So consumers have not really pulled back from an employment point of view. But if you look at their increase in wages and salaries year on year versus the CPI, there's a pretty massive compression there in terms of disposable income. So what does that mean in terms of a net perspective from our perspective? Capital is going to continue to be more expensive this year for growth companies in our portfolios. You're seeing contractions around 50% in terms of multiples on where new fundraisings are getting completed in the last quarter. Nick can talk to us a little bit more about that data if that's of interest. with all those issues in the hands, last 2 months in particular, probably been the most difficult since we started doing our resilience calls. Almost a little over 2 years ago now. And the biggest challenges again is risk of higher interest rates, which I think is very likely, and then the impact of that on the capital structure. Again, I think we went over these numbers last time we spoke. So the S&P still down despite being up recently. I think as of today, still down 11% on the year. The Russell and others also sort of comparably down so far year to date. So liquidity increasingly becomes a big near-term challenge, and so I think you've heard us pretty consistently talk about having 18 months of cash runway as being a really critical issue for all of our CEOs and founders to focus on, to have that liquidity. Now, if the companies don't have it, I think it's going to be more challenging in the sense of the things that you can control in terms of cutting your burn rate, and a number of our companies are making those choices and have already implemented them, as well as trying to do financings. And a couple of the portfolio companies have been able to complete financings since we spoke last, and I'll talk a little bit about that. In terms of where we're seeing the most difficult area of exposure, if you pull the lens back, is really in crypto, EU, China, and then e-commerce companies are the ones who have really been hit the hardest in the first half of the year. Fortunately, on 3 of the 4, we have no exposure at all. So as Bob Posen and I have had deep conversations about this, I don't understand crypto, so I haven't invested in it. Feeling good about that choice right now. So we have no exposure to crypto, no exposure in the EU, and no exposure in China. We have a small exposure in the EU. I guess technically, depending on your perspective, we have a small investment in a company called Newman, which is based in the UK. We do have meaningful exposure on e-commerce companies or e-commerce related. It's about 26% of the portfolio by investment dollar. But we still feel that the portfolio is set up for success long term. And we'll talk more about that as we go through. Any questions on the macro at all? Or Bob Posen, do you have any other thoughts on the macro? You're particularly more thoughtful on those things than I am.
I think your basic analysis is correct. I think we've had a big move off the bottom here, but I don't think, assuming the Ukraine-Russian war continues, I don't see the macroeconomics getting a lot better for the EU in particular. I agree with that. But even in the US, for food and energy to come down as long as that war is continuing is difficult. So I don't think we should be declaring victory now. I agree with you that we're in for a long slog here. Interest rates will go up considerably, but they still can't solve will reduce demand, but they still can't solve the energy and food problem on the supply side. So that's likely to be a problem for quite a while.
Yeah, I was hoping you were going to be more optimistic. I appreciate the confirmation. Bill?
Hey, Chris, let me echo Bob's comment about, and I'm probably a bad penny here, but this whole thing about the energy coming down, brace yourself. If certain things happen, and I'm sure Bob knows, if the EU really does cut off Russia oil, which they have not yet, then there is another supply issue on energy that will give us another shock. Now, maybe there's a way around that, but none of the Russian oil has really been taken off the market. And if it does get taken off the market like they say it will in December, there's and when the SPR stops, the release stops in October, it it's not, you cannot be sanguine about what's going to happen with energy.
Thought you guys were supposed to be having a good time on the vineyard.
Well, you are, but
I'm kidding.
I don't know, Bob, what you think, but that's
No,
I see it
think you're
every
right.
day.
I think the energy will adjust in 2 or 3 years, the supply chains, but the end of this year there's not enough time for them to adjust. And Russia's
Exactly.
likely to put the squeeze on, and EU is squeezing itself because of its sanctions mentality.
Yeah, no, the physical world is not the market seems to be ignoring the physical world, and it's not. You should not be sanguine about energy.
Yeah. So unfortunately, sounds like a consensus on a tough couple of quarters ahead of us. Any other questions on this before we move on? And Chelsea, I got a text from Adrian Rawlinson saying he's having a tough time getting in. I don't know if there's any way for you to check that for us. All right. So moving on. So Q2 2022 update. So, unfortunately, I'd love to say that our portfolio and our founders are immune to the real world, as Bill eloquently put it, but unfortunately not. So from a revenue point of view, if you look at it on an LTM basis, coming out of the first half, the companies did 19.1 million. So that's up slightly from last year, same time. Growth has come down from about 13% year on year to 1%, and that's particularly hitting us with a couple of portfolio companies that are having a tough time, in this environment, which I'll speak to directly. Gross margins have come down a little bit, but still above our target, so down to 41% from 51%.
When you say, you comparing it to the first half of 2021?
We're doing 12 months over 12 months.
I see. Okay.
And then runway's still, looking decent at 17 months. So, kudos to our portfolio companies, for continuing to manage expenses, while raising capital to make sure that they've got enough runway to manage through this. Capital efficiency of growth, interestingly, has not, is largely unchanged, sitting at 3.47. I think, up slightly 1 point. And then total value over invested capital is down slightly to 1.41 from 1.68. And in terms of up rounds, the portfolios had 10 up rounds and 1 additional down round from the last time we talked, from 2 to 3. And I'll get into some more details on the portfolio. Incredibly proud of the fact that we're 56% led by diverse founders, and so that continues to be a point of pride. And honestly, I think one of the things, if you kind of dig through the numbers, is our diverse founders are doing a very good job of managing in a tough environment, maybe a little bit more so than the white dudes. Just saying that out loud. So adversity sometimes is a good school. In terms of overall current fund performance, so again, we're just under 9 million. 73% of that's paid in. Cost of 6 million, 2.2 million in reserves, and about $1 million of fees, startup costs, and fund expense. And as I mentioned before, we're sitting at a TVPI of 1.41. The only really material thing to point out on this slide is we actually have distributed capital back to our SPV holders, in particular the Game Club SPV holders of 263,586. Doppio, as a reminder, exited for 1.41 invested costs. Even Prime Bandshow and Game Club are in exit process. We expect to have a small loss of capital on Even Prime and Bandshow, and I'll talk more about that. And as we spoke about last time, we expect to, and this is a really great shout out again to Dan Sherman, working so hard to get the invested capital back to our investors. And we've got about half now back. And then for the Game Club SPV investors, please let you know we got the the first distribution of this year, now sitting in our accounts, where we should be getting wires out to you by the end of this week for that distribution. But still another 12 months to go in terms of that full earnout. We also, and I think we spoke about this a little bit last quarter, had one of our larger portfolio companies that's doing quite well in confidential registration to go public. Obviously, the public markets has made them decide to kind of pull back on that. But the company continues to have very solid results, and I think when and if markets allow, would be a very material success for the portfolio, but not expecting that until the second half of next year now, given market conditions. Any questions on this slide before I go to the next? All right, silence moves. Some quick updates. So from in-market, they've done a nice, and connecting some dots here for you, but that's the company that's well over 100 million in revenue and north of 20 million in EBITDA, and well positioned to go public. They're navigating this change pretty nicely. A recent piece in the Wall Street Journal about some of their clients, including Dollar General, and how this has actually been helpful to some segments of the market in terms of consumer behavior shifting in terms of where buying is. One of the really interesting things there, and I think goes to the earlier point on U.S. consumer behavior and sort of tale of two cities here on two of our portfolio companies, is Dollar General is now seeing folks with median family income between $35,000 and $60,000 now increasingly part of their consumer mix, whereas it was almost negligible before. So consumers really shifting where they're spending their dollars. Unfortunately, that's hit pretty directly one of our other high-performing companies, Tonal. And so, these high, much higher end, more expensive consumer discretionary purchases, I think, are going to continue to be under pressure for the next year. And and hats off to the Tonal team in recognizing that and preparing for the long run. But they even after, if you recall, last quarter announced a $250 million financing. Companies set up very well from a cash point of view, but despite that, they've made the decision to reduce their workforce by 35% last month to manage expense, given the reality. On another positive note, since we spoke last, some quick ones for you. SignalWire added a new investment that happened right after our last call. So adding T-Mobile onto the cap table, which is great for them, not only from an investment, but also from sales and distribution. And they continue to have nice growth. Harper Wilde, our two awesome founders in Los Angeles, have also have a point of view. I'll put it that way, in terms of where the political situation in the U.S. is, and have leaned into that, and that's really driven some pretty significant revenue increases for them in the last quarter. Two other quick ones. Senso just broke into the U.S., so their first U.S. customers. So there's a nice milestone for them, which they announced earlier last month. And then on Elroy Air, I think Kim is on. I was closer to this one, but they got a very significant order in for their units from Bristow Group, which is one of the larger helicopter groups in the U.S. And I think total order backlog now for Elroy's coming up on almost $1 billion.
Yeah, and Chris, we've got two folks from Elroy on, I think.
So is Dave on?
Dave and Grant.
Oh,
Dave.
wow. Well, guys, my first opportunity to say this live. Congratulations.
Thank you.
Doing a hell of a job in a pretty tough environment. Appreciate all the hard effort.
Sure. Yeah, no, we've continued to thrive and push toward fulfilling these orders. We have the first half of this year was a big one because we unveiled the new vehicle in January, got a bunch of press. We were on the cover of Aviation Week in February, which is kind of like an athlete making the cover of Sports Illustrated. And then in March,
I don't know if you want to use that analogy. Isn't there
an athlete, right?
First making the cover of Sports Illustrated.
All right. Well, point taken. So, and then in March, we announced our partnership with FedEx, which is something we've actually been working on for several years by now, but they were ready to announce it publicly. And that's a big deal because we're now the company they've announced that they're going to work with for this middle mile cargo route where they try to expand the footprint of where they can do express. And then the one you've got here, Bristow, is a big one because it's they operate helicopters. They're the biggest helicopter operator worldwide, and they want to use our system to expand into new markets. So the order backlog now, the demand backlog is more like $2 billion when you count up the humanitarian and the commercial traction that we've got.
And you just raised a bunch of money.
We did. Well, we raised a big round last year, and we're raising some more this year. And we have already like 25 million in this year, which in a year like this feels a little bit like training at altitude. But we're doing it, and got another big defense strategic on the cap table this year, which should help with kind of expanding our product offering into places like the Air Force and other parts of the U.S. government.
Well, congratulations again on the success there, and thank you for giving us the opportunity to participate in the recent round. We're thrilled to be able to do that.
Yeah, gratitude. Happy to have you on board.
Any other questions on this one before I jump in? All right, so so what's the net from a portfolio point of view? And I thought it'd be helpful to kind of give you the percentage exposure to by portfolio, so it gives you a sense of where some of the challenges are. So the yellows can either mean one of two things: significantly slowing growth or funding risk in terms of the 12-month horizon that we're talking about in terms of a tough fundraising environment. So just quickly going through the companies, Appenboard was the one that's really kind of hurting us on growth, and so as much as they had hoped the new game engine would be taking off and their ability to monetize it has taken off in terms of use, but their ability to monetize it hasn't come together as quickly as they had hoped. Senso, as I mentioned, just broke into their first U.S. customers and some nice progress there on the business. Concern here is just they've got a financing that they've got to close, in the fall, and that's going to be a little bit tricky given the environment. In market, as I mentioned, just phenomenal, very solid growth. Should be going public as soon as markets allow. You heard directly from Dave on the awesome progress at Elroy. SignalWire also having a nice progress on the business, as well as additional financing closed since we spoke. CareerList had a very solid quarter, both top line growth and profitability in the prior quarter. Game Club we have as a yellow only because we haven't fully realized that position, but we're contracted to recover capital there, and so watching and working with Dan on that closely, but feel like we're probably going to be fine on that one. As I mentioned earlier, Harper Wild has done extremely well and kind of leaned in. So for one of our e-commerce companies, found a vein that's working for them in terms of continuing to drive growth. Gentrio, I think I've got Renee on. So some really nice progress in the business here. It's more the financing risk, and same with Listo. Any of our companies that have to raise money in the next 6 to 9 months, I think just realistic. It's going to be a tough environment. Same thing with Telly. Tonal, because they raised a significant amount of money last quarter and have done the 35% reduction in burn. I would have said that the growth concerns would have put it to yellow, but I think they're managing the business really well. So leaving that as green. We have a small exposure in Bancho that I believe we're going to have, as I articulated earlier, they're an even prime, a small loss of capital in those two companies before the end of the year. Sunday, both Sunday and Newman, two other e-commerce companies that we have, both actually showing pretty phenomenal resilience in the face of some of the headwinds that we've talked about in e-commerce. Newman growing over 100% year on year this year to date, and I think Nick, Sunday's a little over 200% year on year based on continued growth there. So overall, I would say, given the macro environment we talked about earlier, really proud of the founders that we partnered with, and a tip of the hat to all of them in terms of managing in a very, very difficult environment. Any questions on this slide? All right. In terms of fund timing, so we did an update on this last quarter. So capital accounts are now all locked and loaded. Nick is doing yeoman's job, basically getting tax docs fully completed with Assure and K1s, and Nick to set expectations end of August to get all the K1s out and completed.
Yes, that's correct. We've got fully validated K1s for more than 80% of individual docs. We're just looking to close out the last few and make sure that capital accounts and K1s are speaking to each other correctly.
And then I'm going to circle back with everyone individually, just to have, given sort of the material change in the environment, and make sure that everyone's still comfortable. So Meryl's going to be reaching out to you to set up a time with me over the next 4 weeks. Some of you have already had that opportunity, so I appreciate the time. But basically try to get that done. And then, as we've discussed, there'll be about a 55% capital call in late October. Late October, and finalizing everything by October 15th. Any questions on that slide? And then I'm going to stop sharing so I can actually see everybody. So, headline, tougher environment than I think any of us, would like, but also, very much value all the relationships here, and I think important for us to be really transparent and realistic about sort of where things are and the challenges that are in front of us. So, and I know everyone's working their tail off in a pretty tough environment. So, any questions? Maybe I can bring a couple of the founders like Sam and Renee, Sarup, and maybe just to add your thoughts on where we're sitting, the challenges you've got, and anything we could be doing to help you.
So the good news for us is that we can finally see people in person again, and so it's actually it makes getting deals done a lot faster. So keep your fingers crossed. We have a very good strategic investor that we just have to do few more dotting I's and crossing T's, but it's a huge national player. So hopefully we'll be announcing that at the next call.
Yeah, definitely want to second that. Definitely, the venture environment has definitely been challenging, but we're also leaning on strategics. And I got to say, Renee, you hit it on the mark. Meeting in person, taking that flight to have that face-to-face has created the biggest impact. And didn't realize that during COVID, doing things over Zoom, but just it's night and day difference being face-to-face in person. So definitely same sentiment.
Yeah, likewise on Listos in. We were hoping to close a larger round this year. We were fortunate enough to raise a safe and brought in some pretty solid strategics. One of them is CMFG Ventures, which is the venture arm of Kuna Mutual. They've been phenomenal. They're introducing us to the entire credit union environment, and we're building and have been diligently building deep relationships with them. So we should be onboarding some of these credit unions here shortly. And again, think of me as a resource if you guys are needing to break into that as well. Tarub or anyone else here in the group, happy to leverage those same relationships for the benefit of everyone here. We also had Latitude come in, which has extensive relationships with the major banks. So making good progress there very early on, but speaking with JP Morgan Chase to help them meet their commitment to lend an additional $30 billion to bridge the equity gap, right? So that would be a phenomenal partnership for us and moving very well. Also talking with a partnership with the largest media partner provider in the world for the Spanish language consumer. So we have a lot of great stuff. We've been working around the clock, and now we know that we have to put more positives on the board here to close a nice round, more so than what we had anticipated, but still feeling pretty confident of where we're at.
Are you seeing any difference in the consumer behavior for the customers that you're serving?
Yeah, definitely. So on the lending side, we're seeing an increase in demand, right? And you tend to see that in recessions, but then obviously now that inflation and the cost of living has gone up, there's going to be a larger need for folks to come out and look for credit and continue to build their credit score so that they have the best options out there. So that's actually a pretty good trend for us in the sense that there's more demand out there. And consumers now more than ever have to be more cost conscious. So going to providers that will help them, that will give them good options versus the faster options that are in the market are better. On the insurance side, we are seeing a pretty large, mostly at a macro level, insurance carriers are struggling with skyrocketing losses. So the cost to repair vehicles has skyrocketed just because new cars are short in demand and the chip shortage hasn't been resolved. So the parts and the vehicles themselves, when they have to replace them, are a lot more expensive. And since it's a regulated industry, the regulators are not allowing them to change the rates overnight. So Geico just announced that they're closing all their offices in California, for example, right? At least the brick and mortar offices and sticking with digital. But we see that as a favorable trend as well, right? People that traditionally shopped in those brick and mortar locations will likely want to look for new brands that would give them that sort of the trusting experience they would want from a company like ours. So yeah, I mean, those are really the two biggest trends that we're seeing, Chris, in the market. Slightly up, demand is up on the loan side, and costs are increasing on the insurance side. Which at the end of the day, for Listo, we will make more money since we make a percentage of the outstanding premiums, but it does put a little bit more hardship on consumers.
Thanks for sharing that, Sam. And just as a reminder, Sam's company serves largely underbanked, largely Latinx consumers, through California and the Southwest of the U.S. Evan, I saw you on as well. I don't know if you can jump on and give us a little bit of update on SignalWire.
Sure. Can you hear me okay?
I can. Congratulations on the T-Mobile investment. Well done.
Thank you so much. Yeah, we're really excited about that. Yeah, we pulled in T-Mobile earlier in the year as strategic. We also have Deutsche Telekom in there, so we have the the parent and the favorite child of those guys. So that's been particularly useful for us. We're talking a lot with them about potential avenues to move into closer relationships with the larger carrier telcos, sort of where they're positioning themselves for the 5G enablement going forward. They have spent a lot of money, as we all know, on global 5G deployments. So they want to recoup that in some way. They see technologies like CPaaS and UCaaS, like what SignalWire offers, as the future of that. So a lot of like high level enterprise kind of decision making related to how we work with them. We are the internet bridge they need to developers and sort of the worldwide ecosystem. And they have a lot of value add in terms of existing relationships, legal stuff, all kinds of other opportunities to interface. But those are kind of slow moving. In the short term, we're now partnering with a soon to be announced very large podcasting company, which is building an app based on SignalWire. They're about to release that's going to do some very, very large scale sort of clubhouse audio broadcasting. And we're seeing a ton of traction moving forward in the idea of enabling social communities and people and places that want to have a depth of engagement that's increased. And by using sort of interactive media like we're doing here, combined with large scale broadcast, that is a very interesting thing and opportunity we can address. And some of the technology that SignalWire has differentiates us quite a lot. So you're going to be seeing some announcement about that here in the next month, which is pretty exciting, coinciding with the start of the NFL season. Other than that, we're really seeing a lot of good traction and movement on a lot of fronts, right? We are seeing naturally people struggling to figure out how they monetize their own version of these services. What they're trying to help them out with is how to do that. How do you monetize existing and new video and audio streams in interesting ways? And then naturally, we're still hiring and things like that. And that still remains difficult. Hiring is still a difficult thing to do around the world, particularly in the specialties that we have. But things look pretty good. I think we're all suffering through the same stuff. So, we're lucky that we sort of finished our raise before these economic conditions hit. So we're sitting okay right
now. Congrats on some pretty phenomenal growth first half over last year too.
Thanks so much. Yeah, we're very excited. We're very bullish. Communications, we're also fortunate, tends to do well in a recession. So we're a little bit insulated from things in that regard, but naturally feel the pain, as I'm sure everyone is, as we've already heard.
We're fortunate to have a lot of our founders on. I'm just wondering if there are any questions from Ruth or Jeff, Kurt, Bill, on any of the businesses, or any questions on things that they're facing. Tim, we got you too.
I guess I have one question I could posit.
Mm-hmm.
It kind of goes back to what I was just asking about, whether or not we should be pouring in more energy into these long-term strategic higher enterprise level relationships. We have some investors that are advising us to get into sticky businesses like healthcare and things like that don't change very fast. Sort of more of a sales-led enterprise growth model in some aspects, not like pivoting to do that, but just focusing more energy on that versus really doubling down on a product-led growth strategy, letting developers come and take the forefront and kind of run with things. What are the opinions here on that?
Jeff, your audio is clipping a little bit for me. I don't know if it's clipping.
Yeah, Jeff looks like he might be experiencing some internet connection.
Unfortunate, because he's probably the best positioned across a number of well-positioned guys on this call to answer that question. So we'll let him get to better connectivity. Kurt or Kim, do you got a point of view on that question?
I just want to make sure I understood the question. It was a question of focusing on, shall we say, larger enterprise, sure revenue things versus the masses and the developer community. Was I hearing that right?
Yeah, pretty much.
Yeah.
Do we spend some time working on strategic alignment with things like let's just point like Epic EHR systems and video integration with those, or do we continue to just go with product led?
Yeah, that's a tough one. I was facing this with one of my other companies just last week. I know this is not quite your question, but they're saying at this point, given the difficulty in the market right now, and in particular, if you are trying to raise money or you need to soon, that this focus on the larger opportunities and kind of leave the freemium and the smaller kind of customers to the side right now. But I think your question was more around as well, focusing on product-led stuff versus at the same time strategic opportunity. Those are the things I call night and day stuff, where you still have to do both. I mean, you want to be investing in something that's going to pay off next year if it's a long-term strategic relationship. But obviously, there's a higher and higher focus on revenue and profitable deals right now. That's just kind of the nature of the beast. I'm not sure that's really helping you much, but
No, that's great. Thank you.
Yeah, that was also very helpful for me. So thank you for the question. We did have a product roadmap that's a bit more strategic, was going to take a little bit longer to generate revenue. Now we front loaded features that are going to drive revenue sooner, which is really the shifts we've made and trade-offs we've had to do versus, investing 6 months on a pretty powerful feature that's not going to give you any revenue this year. Right. So just hearing you provide that insight tells us that we're in the right path.
Certainly when it comes to product stuff, that's absolutely the right way to go right now. On the other hand, if there's some strategic relationships that can be help from a go-to-market and generate revenue, those things take a long time to create. You can't quite give up on those if you really feel that it helps. So you have to carve out a little bit of side time for that. But Sam, no, I think the prioritization you're doing right now on the product side absolutely makes right sense.
Those are hard trade-offs, but now we know where the narratives are going here, at least in the investment community.
I mean, the market's always over, as Chris will tell you as well. The market's overreact. The pendulum swings too far immediately. Everybody gets, really short hands at this point. They don't want to invest, and they get greedier to seeing results. And so sometimes you just got to feed that a little bit.
Thank you. That really helped me a lot too, by the way. It's been something that's been on my mind for the last 3 months. Appreciate it.
And Ruth, I know you've been advising Senso directly on some of this, but I don't know if you wanted to jump in, and maybe if Jeff, you're in better connectivity, we'll get you right after Ruth.
Sure. Nick and I have been talking a lot about how to prioritize product features and how to make sure that the team is engaged during the tough times. And that's one of the challenges too, is everybody's kind of shrinking a little bit or not growing a little bit. How do you keep the organizations feeling empowered and moving forward and feeling a sense of urgency and not fear? But also, how do you feel, compelled in seeing successes? And I think that the launching into the U.S. market has been a huge boost to the team to see, the progress they're making. So I think both keeping everybody focused on the right features and keeping the teams organized and engaged and not feeling skittish if they're sensing the fundraising or the financial issues, I think is something to think about as well.
Yeah, and Ruth, thanks so much for your phenomenal advice to Nick. I've been indirectly benefiting from that, so really, really appreciate that.
Excellent. Nick's a great guy. We've been having so many interesting conversations over the past, couple of years and stuff, and it's fabulous to see how he's grown in his role and how how he's really engaged in the strategy part as well as the product part. So it's been really fun for me too.
I've noticed it for sure. Thank you.
Evan, I don't know if it's helpful to you, but I'm happy to get you connected directly with Ruth too. She's got a world of experience 5 times over in some of the things that you're exactly asking about.
Absolutely. I would love to talk anytime. Thank you, Ruth, for the opportunity.
Absolutely.
All right, I'll do that offline later. Jeff, do we have you back on?
Let's try. Can you hear me okay?
Perfect.
Oh, good. So as I guess I was saying, really it's a function of how great is your patience. It's kind of a bit of what Kim was saying earlier, right? A well-executed, sophisticated B2B strategy is not for the faint of heart. It's going to take time. It's going to tap resources. You're going to have to hire appropriately, and have a fair amount of willingness to stick with it through the very hard slog at the beginning when you've got a lot of BD work, and you have to take your wins very they're small wins, but they're important wins. But you may not see the results immediately versus a product-led growth strategy, which is highly viral. You can measure it immediately. You've got probably indicators in your product that show exactly what's happening. It's very data driven. It has the objectivity that you don't get in a B2B sales world. So I think it's really a question of actually one of potentially even of corporate culture. What drives your company? Are you a product-led company who lives and breathes data? And if the answer is yes, then I would suggest you stay that course. If you're like, well, it's working, but we need more, then that's potentially another lever you could add. I don't know enough about your business to tell you that, you should make that investment. There's kind of a middle road you could consider as well, and that is, as the CEO or as the founder of the company, you might want to make it part of your responsibility to engage in some of those strategic conversations around two or three key, you mentioned healthcare companies, but two or three healthcare companies, and give yourself a strategic goal to try and establish that beachhead with one or two of them over the course of the year. And if you feel like that's working, you could easily imagine then pivoting to hire a B2B team. And those are just a few ideas, but I have seen companies that have been very data driven try to move into the B2B space. It's very hard for them because that data becomes less apparent in the more subjective large enterprise sales.
I think you've hit the nail on the head right there, is that we have a combination of people at the company who are both data driven and also sort of long term. So that's the tension right now, is the data driven people want to see results. And we've been doing this launch of this podcasting app was basically a year-long BD effort. It started last October, getting through a POC and then getting through all the legal stuff. And now they've dedicated, they've had 60 guys working on this app now for 3 months, but it's been a lot of, it'll be one of the biggest wins we've had on the BD side yet. And we see more of these coming, particularly in broadcast and entertainment media companies. Healthcare is another avenue we're looking at. But the product-led growth team side of people are very much like, so we need more data on this. That's just the tensions. We're sort of walking that middle line right now.
Yeah.
So that was some great insight. Thank you.
Evan, I got another lead for you on the healthcare side, which might be an easier integration too. So that'll come your way. Didn't know you guys were thinking about it, but it's a company called Voice that does real-time medical translation over video.
Yeah, for sure.
Kurt, I saw you nodding your head. Anything to add on this topic? And I think it's worth spending that time on, because I think almost half the portfolio is thinking about this in one way or another. So Evan, thanks for bringing the topic up.
Yeah, I can just add one. Everything sounds exactly right. I think one of the risks too is if you shut down your pipeline too much and you try to reaccelerate later, you might have already invested a lot in building some of these kind of early partnerships. And so it's almost applying like the prioritization based on probability of success for each of these. And sometimes that's hard to do because you have imperfect information, but you almost need to stack rank where you're going to spend that time and which ones you sort of keep on life support for, so you don't fully lose them along the way. And I think only when you're involved in your business at the depth that all of you are, as Kim was saying, you'll know what that is. And sometimes it's instinct based and sometimes it's data driven, sometimes it's personal relationships. But yeah, you kind of have to go with, I would say, fewer and deeper as opposed to going really broad and spending all your resources on it.
All right, Evan, I think we got some progress for you on that one. And thanks again for bringing it up. Dr. Rawlinson, dare I ask, how bad's COVID going to be in the fall? You're muted though. COVID's not going to be a problem in the fall. Apparently, we're good. It's over. Depending where you are.
We did it. Congratulations, everyone.
Hey, can I do a real quick intro? Jarrett Rakoff's on the call today. He's been part of Gentry, and I think he was on before, but he's been program manager and stuff, and he just sold his company, and they just finished Grassroots Technology and wrapped that up after a 20-year successful run. And so now, if you, he is someone from a project management standpoint. If any of you guys need help with that, Jarrett is now open.
Thanks, Renee. Appreciate the introduction. It's great listening in. Real informative conversation. And yeah, yes, that is the direction I'm headed. A little bit more independent, looking for new opportunities and interesting experiences, like it has been working with Renee, which has been great. So, thank you.
Hey, Chris, can I just throw out 30 seconds of maybe some learning that I got, that maybe those that are trying to raise money right now to be maybe on the cautionary side. This is an example from a company I literally heard of yesterday. They signed a term sheet with a absolute top-notch VC fund, and we're in their final stages of due diligence. About a week away from, checks starting to fly. And the firm came back and said, we can't do the deal. And it had nothing to do with them and due diligence on them. It was a firm that was suddenly having to kill about 4 or 5 of their deals, basically because that firm itself, their LPs, because of the macro environment that we're in right now, are starting to pull back. And when they start to pull back, there's less, room to work with. So I guess all I can say is, as desperate as we sometimes are to get money, and they're doing checks on us, we got to do some checks on the VC funds themselves to make sure that at the end of the day they can come up with the goods, because right now you can't take anything for granted. Hate to be a Debbie Downer, but that was one yesterday I thought I'd share.
Yeah, I don't think it's going to be as bad as 08 when LPs weren't making capital calls, but there's no question liquidity's pretty tight right now, up and down the spectrum, and that's why again a very painful decision for the Tonal team, and the awesome teammates they had, but I think ultimately it was the right decision in terms of making sure that they were able to manage through this window, and laying off almost a third of the company last month. So it was a tough one there, but I think the right call given all the data. So I guess different way of control the things you can control, and make sure that you're optimizing for that 18-month window.
I just wanted to add to what you're just talking about, Kim. We had a deal on the table for a couple million investment, and at the last minute, they used the economy to change some of the terms, and it was very interesting where everything would have gone in their direction, and so I said no. So we tried to negotiate with them, and they kept taking it, but it was going a little too far, and they're like, well, this is when you need to get money, and I was like, you make lots of sense, but I have a checkbook. So.
Renee, you just reminded me why I love this group. Frickin' tenacious, hardworking, and I know you're all going to be able to get through it. And Ruth, thank you for offering to help out with Evan, helping out with Senso. I know Kim's been working really closely with the Elroy team, this last quarter, and I just want to thank everyone on the call for working together to kind of manage through here. Much appreciated. And Sam, really appreciate that offer to help Senso on the connections to the other credit unions.
Absolutely. Thanks, guys. Thanks for hosting, Chris and team. Appreciate it.
All right. Have a great summer, guys. We'll talk in a couple of months.
See everybody. Bye-bye now.
Everybody. Thank you.